Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Anton Mattli. Thanks for being on the show, Anton.
Yeah, thanks for having me on, Whitney.
Yeah, I can't believe it's taken 850 plus shows to get you on the show, Anton. We've been in a mastermind for a good while now together and heard him speak numerous times about financing and help so many people just think through and better understand financing for syndications and the pitfalls. He's extremely experienced, which you're going to hear a little bit about. So looking forward to this conversation, Anton. Pleasure to have you on the show. But a little about him. He's a CEO of Peak Financing and has decades of experience in commercial and investment banking, private equity, and commercial real estate. After graduating from Zurich Business School in banking and finance, held senior management positions at major financial institutions in New York, Tokyo, Hong Kong, and Zurich. During that time, Anton was heading a bank branch, managing cross-border teams, financing and restructuring commercial real estate worth several billion US dollars, and overseeing loan portfolios consisting of aircraft and ocean transport vessels. Anton also directs and structuring of complex cross-border commodity and trade finance transactions for Fortune 500 companies. So Anton, thank you so much for your time and being on the show, being willing to share with us and help us to better understand just the financing piece and things that are happening right now in our market. I know you keep up with those things better than probably any of us can. And so give us a little more, about your focus in this industry right now. And let's jump into just, the current financing situations and pitfalls for syndicators.
Sure, absolutely. Thanks again for having me on. Our focus is to finance, as we call it, the middle market segment. Right? I come from an institutional background, and that typically, when it comes to asset sizes, is 50 million and up. Below that, we call it the middle market, and that's where our firm are primarily focused on. And when it comes to the syndication space, that's where we help a lot of syndicators. As you know, a lot of syndicators are active in the multifamily space, so that's only the biggest chunk of the syndication financing we do. But we also do other commercial real estate like office buildings, retail, mobile home parks, self-storage, and all that. It's just that multifamily is only a big piece of what we do.
Now, and just the terminology there, just a little bit, you talked about like the middle market segment, and you said that's, 50 million and up, or that's 50, or what was those ranges again?
50 million and below, right? So the true institutional players, they tend to focus on asset sizes that tend to be 50 million and up. Sometimes they may go for 35, 40 million assets, but most of them really focus on much larger assets. Once you are in that, as we call it, the middle market segment, it's more syndicators, private individuals, maybe family offices that invest in these assets. And that's where we add the most value, because institutional players, they typically have their in-house financing in place. So they do not really need that much of our assistance, because they have a large team that does it on a daily basis, essentially doing what we are doing for our clients. And that's the reason why we focus primarily on the middle market.
No, that makes complete sense. Appreciate you elaborating on that. Sometimes, especially listeners, you're getting new into this business, you don't understand some of the terminology and what that means. Well, let's jump in, to just, with the financing situation as we speak. Obviously, we're in, mid-January right now when we're recording this, just so the listener knows. But Anton, why don't you just give us kind of an update? And I'd also love to learn, just how, someone like ourselves that's in the syndication business, we're doing deals. However, we're not in the financing side of it like you are. How can we gain more knowledge and just stay up to date on, more of what's happening? How do you do that? Or how do you suggest that we do that?
Yes. So one of the best ways to stay up to date, obviously, just stay in touch with trusted advisors, right? Obviously with us on the financing side. read a lot of reports from lenders, also read whatever reports you can get. It's important that you are aware of where interest rates are in the marketplace, whether it's a treasury yield and other interest rates that are driving the real estate financing market. So that's really the crucial piece. At the same time, when you stay in touch, really ask the right questions. What has changed over the last couple of years or couple of months? So as a perfect example, is that you may have heard me talk about Freddie SBL as an example. That is a perfect entry point for someone who doesn't have experience in multifamily syndication, because Freddie SBL essentially allowed for an inexperienced investor or syndicator to do their first deal as long as they're third-party management. Well, that is now out the window, and we still get calls and requests from individuals that have heard us, may have heard me or one of my colleagues a year ago or 2 years ago, thinking, oh, that's the way to go. And now today we have to tell them, sorry, the situation has changed. So it's important to stay up to date of what is happening.
No doubt about it. No, I appreciate you bringing that up, because I'm sure, there's probably many listeners who trying to get into this business, making especially their first deal or two happen. They've probably heard of that, and some of them are thinking maybe that's a good option. But at the moment, that's gone. Do you see that coming back at all, or is this just kind of off the table right now?
I don't see that it comes back anytime soon. We never know what's happening in a year or 2 years from now. But talking about particularly the last year, when we look at through COVID-19, that it's on everyone's mind, the loans that have had the most difficulties already pre-COVID, but it's only has shown up being more so during the COVID-19 situation, are the smaller loans, and the smaller loans with newbie, as we call them, buyers that are the first-time buyers, really make up a big bulk of the problem loans. And as a result, obviously, the agencies and other lenders too are now much more careful with someone who has no experience at all in multifamily or any commercial real estate. So they just take a more careful approach.
So is that, that individual that's listening now is thinking, oh no, Anton, I was hoping that would work for me to get that first deal done. Are we going to go to, they're going to have to partner with somebody that has the experience, bring somebody in that has the experience. Is that kind of going to be the route for them now?
Absolutely. That's the right approach. Frankly speaking, we always recommended that even previously, right? So even though it was available for someone to do it on his or her own, we always recommended to partner up with someone, because you avoid so many mistakes if you partner up with someone who has already gone through that situation. Now it's just a must, and that's really the best way, right? And that's if you have a good deal or a great deal that you find, as you know, Whitney, there are so many people out there that are willing to partner up with you. So it's not that you're not able to find partners. What is required is that you expand your network well before you find that deal, so that once you find that great deal, you already have the ability to reach out to someone, right? So you cannot just find a deal and then start calling people. Then they don't know you, and they unlikely will partner up with you.
No, that's great advice. Expand your network before the deal, right?
Yes.
So while we're on that topic too, about you were saying about asking the right questions, I wanted to go back to that. When we are speaking to someone like yourself, help us to think about, what questions are the most important, just so we do get a really good glimpse into what's happening right now, just in the, financial market.
Yes. So really what is important for anyone to understand, just because you receive a T12 and a rent roll, that doesn't mean that the lender will take that T12 and rent roll, so the financials, right, and say, yes, we will provide financing based on these numbers. So ask, how would a lender underwrite this particular deal? And that is probably the most important question that one should ask, because that's where we see the biggest mistakes, where someone is underwriting a deal, submits an offer, sometimes even goes under a PSA, And then they start seeking out financing, and then they are all surprised when the loan proceeds and other terms of that loan do not come in at the level that they originally anticipated.
What are going to be like, how are we going to know that? Or what are going to be some of the issues that you're going to see there of how the operator underwrote versus how the lender's going to underwrite?
Yes, so unless it's a bridge loan, obviously bridge loans are a little bit of a different animal where we can underwrite to pro forma. But when it comes to the typical stabilized transaction, a lender underwrites to the last 3 months, as a general rule, the last 3 months of rent collections, the last 12 months of other income collections. And then the lender will underwrite the expenses to their own underwriting standards, as well as to what the appraiser will underwrite these expenses to. So it doesn't matter where the T12 expenses are, it doesn't matter where you think that where the expenses can be. It's really what the lender and the appraiser thinks where the expenses come in. Now, on top of that, particularly when it comes to Freddie loans, Freddie will very often even override what an appraiser will say or what the lender will say, because they take essentially all of that risk. So it's not a shared risk. So sometimes we see deals where we have lower expenses and then Freddie comes back and says, I think the expenses need to be raised. So it's important to understand that particularly the expenses, it doesn't matter what the T12 shows, and it doesn't matter what you as a buyer think where the expenses will be.
What's the best timeline there as far as, showing this deal to you, and then obviously getting in front of the agency as well, before we're obviously have hard earnest money, things like that. So we know, we can proceed with this deal like we think the underwriting should be.
Yes. So the best way really is that once you find a deal that you think makes sense, obviously go, particularly in the current environment where you have a lot of buyers out there, it's definitely still a seller's market. We cannot look at every single deal that someone is looking at, but if someone is underwriting a deal and feels like, I think this is a good deal and I think we want to make a run for it, and we want to submit an LOI, that's the point when they should reach out to us so we can essentially validate their own assumptions when it comes to loan proceeds, interest rates, interest only, and so on.
So let's jump a little bit ahead to, just some of the pitfalls for syndicators right now, or financing pitfalls that you're seeing, and maybe just more current situations, for our current market that you have an eye to that we don't, that you could help us with.
Yes, so we now have the 2020 has passed, right? So for some, I would say the timeline probably was running away from them, right? Where they thought that they could close by year end and then they run out of time. So now we don't have that situation, luckily, until this year in November and December. But that is something that everyone should be aware of. Very often you think you have 60 days to close, so much time. And in reality, it's a very tight time frame because there are so many various items that need to be addressed. Now, the other pitfalls, really what is so important for everyone to understand is, and particularly for someone who comes from residential real estate, where you apply for a loan, you very often can get that rate locked, and you know that you essentially get these loan proceeds within a couple of weeks when you close. This is just not the case in commercial real estate, including multifamily, right? So even if someone gives you soft quotes, these soft quotes are always subject to changes. Even if you get a loan application, that's no guarantee, right? So it's subject to the underwriting, it's subject to future collections, right? So if you apply today and you may submit December collections and T12s, if the collections come in lower in January, that may negatively impact the loan proceeds, right? If interest rates move up from today until you do the so-called rate lock, your loan proceeds might be negatively impacted. Same thing, if interest rates move up, your overall loan proceeds may be lower because your interest rate is higher and your debt service coverage constrained with your loan. So it's important to understand that you just do not know 100% where your loan proceeds and terms come in until you have that final loan commitment. And that is, in most instances, maybe just a week or two before you closed out on that deal.
You know, you had mentioned even before we started a little bit, you're talking about like the treasury yields and what's happening right now, and everything that affects, you know, through the deal or to the closing table for sure. You know, when we say treasury yields, I just like for you to elaborate a little bit. A lot of listeners, you know, have not heard that terminology. They may not understand really what we're talking about there, but could you elaborate on that? And then, you know, the current market of that, and then what does that affect?
Yes. So here we really specifically talk about non-recourse loans, whether they are typically with the agencies, and CMBS loans, which are the most common loans, but certainly on multifamily side, it's Fannie and Freddie multifamily loans. Most syndicators and buyers in general, and even owners that refinance, to go for around 10-year terms. Sometimes to go for 7 years, sometimes for 12 years, but that's the generally 10 and 12 year are probably the most popular loan terms. And for the actual interest rate, that is based on the so-called 10-year treasury. And that's, you have treasury bonds that are being issued by the US government, and they trade in the market on a daily basis. And whatever the interest rate yield is for that investor and at a particular time, that is what is the interest rate is based on for that loan, right? So you take a treasury yield of, let's say, today at roughly 1.15%. It's a little bit higher, but just to take a round number. And then the lender adds a spread to that, which can vary quite a bit from deal to deal. But the treasury yield plus the spread ultimately translates to the interest rate.
Okay, so where would we see that or watch the treasury yield? How do we stay up to date on that?
There are various sources. You can go on Bloomberg, you can go on to the Wall Street Journal and many other sites where they are tracking it, not just on a daily basis, but even intraday. You do not have to even subscribe to a service to follow that. So it's a very, very easy way to track that. Now, what is much harder is to track where the spreads are. And the spreads change on a regular basis, and the spreads depend so much on the property, on the market, even on the sponsors. And that's where really we come back into play, where we can tell you, roughly speaking, where spreads will be for a particular deal. Right, so it can be,
and that's because you're going to.
Yeah.
Go ahead.
Yeah, so it can be that the base spread might be that your all-in interest rate is at 3.5%, right? But if it's a great deal with a great sponsor, and depending on the leverage, you may get down into the low 3%. And for someone else and another deal, it might be in the upper 3s to the low 4s, right? So there's a wide variety of interest rates depending on deal that is based on property size, sponsor quality, asset quality, so many variations that can impact that spread.
And that's going to go back to that relationship with somebody like yourself, right? And we were talking about earlier, asking you, hey, you know, is this underwritten properly or the way that you would as a lender? Is that accurate?
Absolutely, yeah.
So, Anton, any other before we move it on to a few final questions, any other tips or anything you'd like to provide just for our current market that, you know, the operator right now that's listening needs to know?
Yeah, so I would say the key piece really is, do not pick a broker or a lender based on an indicative term sheet, right? Right now we have discussion with a buying group. They collected a couple of term sheets from various brokers, and they come back to us and say, well, you are pretty competitive, but we have another quote that is a few basis points lower, right? So it doesn't matter, right? We have no control over ultimately where that spread is going to be. and just realize that it's all a best estimate when we quote. Even when you get a loan application, it's not guaranteed yet. It's really when the loan commitment is issued.
So Anton, I ask, operators that are on the show all the time about, how they prepare for a downturn. And from your seat, as that lender, that person on our team that's helping us think through those things, I'd love to know what, especially, what we're in now through this pandemic, who has, what operators have survived the best, and why, how are they prepared, and how do you like to see people prepared now as they're sending you deals or sending you underwriting? What does that look like to be prepared moving forward as well?
Yes, so I would say whenever a downturn comes, one of the key pieces is that you do not have a forced capital event, right? So in other words, that you do not have to sell, or that you do not have to refinance during that period, right? So that means when it comes to the financing, make sure that you do not have to refinance at any time within less than 2 years. Because if you have to, you have a pretty significant risk that you cannot refinance. Now, obviously, the exception is when it comes to bridge loans, there is no other way around there. And as long as there is enough meat on the bone and you have an experienced operator, that is still fine, right? But for a stabilized asset, you definitely do not want to be caught in a situation where you have to refinance doing a downturn. Now, how to make sure that you are not forced to sell a property during a downturn or go into a default with a loan is that you raise more equity so that you have more of a cushion, right? So now some of that is forced by the lenders, as you and a lot of your listeners have heard. We have all these principal and interest escrow requirements by both Fannie and Freddie. And a lot of buyers obviously are balking at these numbers. We are not happy about that either, but we are not really happy about it because it's sitting with the lender and outside of our control. However, we still believe that it's the right thing to raise that money up front so that it's available for that bad day when you actually need to have access to that cash, right? So whether you have that P&I escrow requirement or not, I think it's important that you raise that money so that you have that additional cushion in place.
No doubt. Is there a way that you like to see that calculated as far as like a reserve or emergency budget?
It really depends a lot on the leverage of the deal, on the in-place debt service coverage. I personally would say you should try to have a situation where you will be able to cover at least 3 months without any collections, right? So, and obviously with the principal and interest you've reserved that you're forced to do, you will be in a good spot there. But even if you do not have it, that's what I would recommend in the current environment to do. Some are more aggressive, others are actually even more conservative, right?
So what about just you? I know you don't have a crystal ball, but just your long-term experience, in real estate. What do you see the next 6 to 12 months? What's your expectation in real estate market?
Yeah, so obviously there are very different environments we are seeing. Multifamily has been very strong throughout the whole COVID-19 situation. We have had maybe 2 months where it was really tough from middle of March, maybe into May, and then everything started to improving very quickly. So there we continue to see a strong interest there compared to the other asset classes. Obviously, hospitality and retail are still suffering greatly. I think hospitality sees massive opportunity, but it's primarily opportunities for cash buyers or very low leverage buyers that can pick up deals on the at cents on the dollar. I do not really see that's going to happen in the multifamily space because it's just too much too much interest and money allocation from investors, including institutionals, that go into that space. So I do not really see that is going to change. I think we probably, and again, that's just my crystal ball, I think we will see some stress in the first half of this year, including multifamily, because we will see some collection issues that are popping up. And that might be a brief period where there are some buying opportunities for syndicators. But as we get into, particularly when the majority of the population is vaccinated, I think we will see a very strong rebound in the economy. I also feel that if someone is currently owning real estate and they think about refinancing, they probably should refinance now. Everyone talks about the low interest rate environment. I'm not really that confident that is going to be the case. So I would say the upside risk from my perspective is higher than the downside chances when it comes to financing.
Awesome. Well, Anton, just a little shift. Do you have any daily habits that you are disciplined about that have helped you achieve success?
My daily habit is really just focus, right? Get up and start focusing on what you need to do, and do not lose the focus, right? Obviously, everyone talks about getting their task lists in orders and all that. That's all fine, and I try to do that as much as I can. But I think whatever you do throughout the day, I would say focus is on whatever you do at that given point is so crucial, so that you are not distracted by anything else, right? And obviously with that, it's really structuring your day that you have the ability to focus on a particular item, finish it, and then move on to the next.
What's the number one thing that's contributed to your success?
Persistence. I have gone through a lot of up and downs, right? With various economies. I was in the US, I was in Asia, in Europe. I experienced of massive negative situations in economies, which also had a negative impact on our personal investments and personal life. So I would say it's really persistence and realizing that it's just a snapshot in time and things are going to improve regardless of on what situation you're in. That is probably the biggest contributor to my success.
And how do you like to give back?
Well, we do a couple of things, but I would say because we are very active in multifamily. What we support is a local homeless shelter, the only homeless shelter in our county, where we have one of our offices here in Dallas. And it's a homeless shelter that is a little bit different from most, that they are not just feeding the homeless and housing the homeless, but they are actually actively supporting them to get back on their feet and be independent. And it's called the Samaritan Inn in McKinney, Texas. And so that's where we are very actively involved with.
Anton, pleasure to have you on the show. I'm grateful for your time and just sharing your expertise and just knowledge, really your sight inside of the current financing market and what's happening right now, in the real estate market, and just providing your insight and just going through so many things, from institutional players to middle market to how we should educate ourselves and staying on top of different things and treasury yields and what that is, and even to refining now and emergency reserves. Grateful for your time. Tell the listeners how they can get in touch with you and learn more about you.
Sure. The easiest really is by email. My email address is anton@peakfinancing.com. You also can find me on LinkedIn, on Facebook. I'm very active there too. So it's pretty easy to find me.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate. while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.